This is the current federal tax developments for the week of February the 17th, 2025. Current federal tax developments are brought to you by your state society of CPAs, and we're going to talk this week about some things that have gone on over the week. I'm Ed Zollers. I'm coming to you from Phoenix, Arizona. We're here now after, well, apparently, probably by Tuesday, is when the brokers are supposed to have the first sets of consolidated 1099s. We know there will be corrected versions, but unless they've gotten that extension request in place, we should be getting most of our brokerage stuff in. So now probably we can say the real individual tax season is underway. This week, we're going to look at a few things. We're going to talk about a loss deduction problem in the case of Weston v. One commissioner, I guess. That really deals just simply with the issue of what is a business loss and what level of activity you have to get to be able to claim a business loss as opposed to simply having an investment in the project. I'm going to talk about yet another conservation easement problem with Green Valley Investors, LLC. We got the updates on the automotive depreciation lease inclusion amounts for 2025, so we'll go over that briefly. We have another case of an S corporation inadvertent termination relief being granted. This case, the failure to make a qualified subchapter S trust election. We'll talk about the government briefs in the Corporate Transparency Act. Look at the differences and kind of the various things we're seeing. We've had more and more cases develop here. We're having the government now, as we saw beginning last week, beginning to file briefs in the various cases challenging the Corporate Transparency Act. And we'll just kind of take a look roughly at what's going on there. And we did have the House Ways and Means Committee did kick out after a long discussion that ultimately didn't affect the vote on the bills. Just a nice complaining session for the minority party involving, access by the Doge group to items in Treasury. But other than that, we ended up, though, with 4 bills that passed out of Ways and Means unanimously. So, again, like the discussion we had with the Senate proposal a couple weeks back, this is more of a discussion of just administrative fixes that probably can get rather strong congressional support from both sides of the aisle, regardless of how things go forward. So we'll talk a little bit about that and how that one came up. So our first case for this week is a case of Weston v. Commissioner. The Weston case, we're looking there at, it was Tax Court Memorandum Decision 2025-16, and it came down on February the 12th. Now, this case, we had a $2.1 million loss deduction that the Westons attempted to claim. And the issue was whether Mr. Weston's investments in an Indiana business, now he was not in Indiana, he was out of state, qualified for loss deductions. And he had 3 separate theories as to how they would get here. And the key issue we're going to discover is if you're going to try to claim something as a business loss, you need to be actively engaged in the business to claim a business loss deduction. The key question here was, was this a business activity for him? Or did it just amount to an investment where he was essentially helping fund a person who was actually running the business on their own? So, basic background of the case. Mr. Weston was a real estate agent, and he invested in 2 Indiana businesses managed by Mr. Broughton, a house renovation business and a demolition and excavation business. So he had extra funds, he did them. Now, oral agreements were made for profit sharing. This becomes an interesting part of the case because nowhere in here do they really start arguing over whether or not there was a partnership in play. Because that would have changed this a bit in terms of how it would have been a business interest. But in essence, they just had some oral agreements on how they would split the profits. Kind of the traditional real estate issue of the deal as opposed to the partnership, right? Too often we get those, and if they don't want to bring legal counsel in, we seem to sometimes just get the deal. And, and the deal is oral because everything's on a handshake, etc., which works great till things go wrong. Then it didn't. Now, he had been pouring money into both of these businesses. So we're going to be home renovation, basically flipping houses, and he was going to be doing a demolition and excavation business. Now, his operations manager noted a lack of progress by this. He has one that's like, this doesn't really seem to be doing much. I mean, he doesn't seem to be really getting anywhere. And, he certainly lacked confidence saying, I don't think this is going to work out the way you think it is by letting this guy, your guy on the ground in Indiana, take care of this. It's just not working out. Now, Mr. Weston did stop funding new renovation projects. In essence, yeah. If he's not moving very fast renovating houses that you've already bought and getting them sold and flipping them and making money, he wasn't going to go pick up new ones. So he just basically cut that off. Wasn't going to do any new renovation projects with Mr. Broughton. But he did continue to fund the demolition business. But then he also discovered some weird issues with the property titles that he had. And this was just sloppiness. They didn't really allege it was much more than this. But it certainly looked sloppy. The titles to the tax deed properties were incorrectly listed as belonging to ADR Properties LLC instead of his actual company, ADR Homes LLC. He did take steps to correct this error, and he became more involved in the demolition excavation business, the one he was continuing to fund. And he made several payments directly to subcontractors and employees. And he also, acquired a property in Culver, Indiana, as compensation for this business, which went by the name of Freedom First. It may have been freedom from work. We're not sure for the other side of this, but in essence, that was where we got. He did have all of these issues coming up, which were not minor, shall we say, in this issue. He also consulted with an attorney about possibly litigation against Mr. Broughton. And even talked about criminal charges, but he did not pursue those charges. That's going to turn out to be also important for one of his theories, right? And in the midst of all of this, the Westons requested an extension to file their 2017 return, but they never did get it filed, on timely. In fact, their joint 2017 return was finally filed and signed on January 8th of 2020, a little while later. And they did claim a theft loss of $2,035,914 related to the individual Indiana investments. This was not processed by the IRS. It kind of came up when the IRS started saying, where's your return? Okay. So we have a few ways that the taxpayers now are going to argue that they are entitled to these losses. Okay. First argument that he made was, one they looked at was, was this a theft loss? So let's take a look at that issues, right? This was an alternative to their claim that this was a trade or business. And, they said it was under Section 165A and C1 of the Internal Revenue Code, right? In those issues that we had, or C3, I should say, that it was a theft loss, right? It was kind of one of their alternatives. Now, the problem was the court said, okay, generally to be a theft loss, okay, you've got to show that, it was a theft under local law, right? That this was a theft under local law. And they really couldn't show that, right? The court noted there was no proof that Mr. Broughton had intent to deprive. They said there's just really proof he wasn't competent. Right? Incompetence is not criminal, right? It's not theft. It's simply incompetence, right? He was not competent. That was a serious problem they had, right? They also found there was a reasonable prospect of some recovery. There was stuff out there, right? In essence, they still had title to things. They still had issues. In 2017, there was a prospect of recovering it. So because of that, therefore, no theft loss could have been claimed, even if it was there. And while not fatal to the case, as of course noted, they didn't pursue, any filings or any items in terms of, going to criminal charges. And that is a negative if you want to do the theft loss, right? That's part of the issue. Now, their other concerns, was it a business expense? They said no. This, in fact, looked a lot more. They had an intent to make a profit, They failed to show, though, they were regularly and actively engaged in a business. This goes back to the old Grotzinger decision from the U.S. Supreme Court. It's a facts and circumstances looking at essentially citing the Sestak case from 2022. Is there an intent to earn a profit? Is there regular and active engagement? And did the business activity commence? Two of those three they did, but there was not regular and active engagement. This was a very hands-off operation. As I note, it's kind of interesting because had this been a partnership, then it probably wouldn't have mattered. But the court thought it was more in line with the way it was structured, with what was discussed in the Whipple case from 1963, citing Higgins from 1941, that basic principle that managing one's investments, no matter how extensive, does not rise to a trade or business. Mr. Weston was primarily in California, right? He primarily did his California real estate business, rarely visited the sites in Indiana. And they said, well, he's really an investor, not actively engaged. And they said also, so that basically killed off with his business expenses. And they also said it also kills off, because that had been just a simple 162 deduction, was it a 165 loss from a trade or business? And the court felt it wasn't that either, right? With the home renovation business, they said, direct and indirect costs of property for resale, are inventory costs. You got to wait till you sell the property. They said, so that one's offline, right? Once they sold the property, they could recover the costs. That's kind of how it would go. For demolition, some payments were made in 2016, and these funds were used to purchase an excavator, right? Capital costs are not deductible, absent a 179 election, which was not made, and they did not provide sufficient information to estimate any 165 loss. So while Cohen does allow you with inadequate records to claim a loss, and the court cited Cohen, this is one of those cases where the minute the court says Cohen, it's not really good news for the taxpayer, because what they're going to say is you didn't have a basis to estimate the loss, which was required in the Cohen decision and later cases that they cited. So bottom line, not a $2.1 million issue. And the court also found they had no real excuse for not timely filing their return. So bottom line, yep, loss disallowed and penalties applied. Okay, so not a good day for our taxpayers. Next case up is a conservation easement case. This is Green Valley Investors. Tax Court Memorandum Decision 2025-15. This came up on February the 12th of 2025 was the case. Okay. Now, this case, as you'll note here, the tax court disallowed $90 million in charitable contribution deductions for conservation easements. The real issue was whether these deeds complied with Section 170 and whether the valuations were accurate, right? And it looks at the strict requirements for conservation easement donations and the importance of having an accurate valuation. So bottom line, this is where we go. Okay, so let's take a look at the background of this case. Now, this almost sounds like some fictional name, but Bobby A. Branch, he acquired land and transferred that land to 4 partnerships. Okay, so he did. He acquired land back in 2011. So he has these lands. He transfers them to 4 partnerships: Green Valley, Big Hill, Tick Creek, Vista Hill. Right. Each of the partnerships granted a conservation easement to Triangle Land Conservancy. Right. They grant basically 3 of them granted their easements in 2014. Vista Hill granted its in 2015. Then they claimed a substantial non-cash charitable contribution deduction on the return. And these deductions range from $22,498,000 to $22,626,000 per partnership. So basically right in the middle between $22 and $23 million on the partnerships, right? These partnership interests were marketed to investors using a private placement memorandum, which basically did what you might expect. They said, hey, we're going to use this strategy, a conservation easement, to generate really huge tax deductions. They said, you invest $100,000, we expect you're going to be receiving a allocation on the K1 of $437,645 in federal and state charitable contributions. That's an oddly exact approximate, but still, right? They explained that this was significant opportunities exist to effectively mitigate one's federal and state taxes, while at the same time being able to take part in conservation programs that create and preserve green space for future generations. You will be basically ecologically good person, and oh, by the way, you'll be more than adequately compensated. As you look at that ratio of 437, 645, assuming you got that, let's say a $440,000 contribution, and you're in the 37% bracket, plus we're looking at state tax issues that could be involved, yeah, you're going to more than pay for your $100,000 contribution. So it basically becomes a no-brainer, right? You're going to get this nice, huge contribution. You're going to put $100,000 in, get this nice, huge contribution out, and hey, the world's great. Now, I've always said the problem with that is the marketing materials become your biggest negative when a court looks at it. It's like, what rational person would have, sold, firstly, partnership interest in this? Why didn't you just sell the land? I mean, selling the land would have gotten you a lot more money, assuming it's worth this much, right? So you would have been way better off just sold the land instead of selling it for 100 grand. Selling for 100 grand, what you're saying is going to be almost certainly worth well over 400 grand later, because remember, this is the conservation easement. There's still going to be some additional value in the property. We're not giving the entire land. So, why would you do that? And, and the real catch is, and then secondly, how could you know something that you're selling for 100 grand today, assuming, you're selling for 100 grand, which, by the way, the court's probably going to come to the conclusion, which they often do, that, yeah, the real value of that property, your share of it, was probably around 100 grand. You might have overpaid slightly for it, but that, it's probably right in that area. Rather, they're going to say, how did you know it would suddenly shoot up to over 4 times in value? Probably 5 times, because again, this is a conservation easement, not the entire value of the property. How in the world would you know that? Not surprisingly, the IRS audited the partnerships. They disallowed the claim deductions. They said a couple of things. It didn't comply with the requirements of 170. First, the requirement that the conservation purpose be protected in perpetuity. IRS has been doing a lot of tax on that one. And they also determined the partnerships had grossly misstated the value of donated easements, and they asserted penalties in that case. So a couple of issues here. You fouled up foot fault in how you drafted the conservation easement. And number 2, even if the foot fault's not fatal, you still got a big problem that the value of the easement granted was worth nowhere near what was being claimed on the tax returns. So we'll take a look at this. Now, in this case, the taxpayers were saying, they basically had the court's analysis of the law, right? Obviously the taxpayer disagreed with all of this, saying that, everything is fine, that they complied with the extinguishment proceeds rule. We'll talk about in a second here. On easement deeds, they also said that their valuation was, perfectly good and fine. It was there, and also that they claimed they were not accuracy-related penalties were improper, right, in that case. So what did the tax court say? Okay, let's take a look at this. Did they comply with Treasury Regulation 1.170A-14G6, which is interpreting Section 170H5A of the Internal Revenue Code, right? And the court found they did, right? The problem there is, and this is what's happened, these are the proceeds regulations. And the way the proceeds regulations work is that when you gift property to the charity, there has to be something in there if, let's say, a government comes by later using eminent domain, forces the property to be sold off, right? So that would extinguish the conservation easement. You can't prevent that from happening. But what you do have to do, though, is say that when you do have a sale of the property, the donee organization must receive a proportionate share of the proceeds equal to the value of the easement at the time of donation. Now, What's happening here, and this has come up in a few cases, and the courts are ruling this way, they've gone this route. The easement said, they had that proportional rule, but they said, but if the property's improved, which of course they were planning to do, that the value, that in essence, the share of the proceeds be reduced by the value of any improvements that were on the property made after the easement, right? So the idea being that, improvements on the property would change the ratio. So if, let's say, currently that easement represented 90% of the value of the property, well, if we then went ahead and improved the property in line with the easement, and, we put these improvements on the property, if those improvements were now worth, meant that the improved property, the property and improvements, that other than the easement, that in essence we had added 50% and they would make up more of the value, that the value of those improvements would come off of the sales proceeds. As you might guess, there's concern here. First thing is the reg doesn't say anything about doing it. The courts are saying no. And I'm certain the courts are thinking, yeah, that'd be the perfect way to game the system. You just overvalue the improvements and would greatly reduce what would go to the charity. So they don't really buy it. And there have been previous cases, PBBM Rose Hill Limited from the Fifth Circuit in 2018 and Cole Property Holding LLC, a tax court published decision in 2019. The proceeds regulation does not allow for any reduction of their share for improvements. So first thing is, that's an automatic big problem, right? That means it is invalid. And also it rejected the general language that the deeds referring to compliance with the regulation or interpreted clause could override specific language, right? In essence, the savings clause didn't work, right? Specific language of deeds control the general savings clause could not retroactively. They attempted to paper it over, say, if this violates the regs, anything in the deed violates the regs, then, that overrides it. The problem with that is that obviously a party has to assert that, and somebody's got to defend it. There's no obvious point who's going to defend it. They cite there the Belk case from the Fourth Circuit in 2014, and Cole Property Holdings, again, same published tax court case from 2019, that they'd cited before for that purpose, right? Now, in Belk, the taxpayer's intent to retain disqualifying power was clear from the face of easement, and such a condition, subsequent savings clause, referring to the statute and applicable regulations, could not save the deduction, right? The courts look very, very skeptically at savings clauses. It doesn't mean that they shouldn't be included, but it does mean they aren't likely to work, right? It's much better to make sure that your agreement, your documents, don't need to rely on the savings clause, right? It's possible it can work in some cases, but in taxes and things like that, especially with charitable contributions, it's very difficult. We've seen that also in estate tax issues where we've had savings clauses like this that, again, right, the courts haven't been too thrilled about using those. Okay. Now, the valuation issue came down to the conservation easement. Again, they did agree that before and after was the way to do it. But what they're saying was the valuation that the taxpayer had gotten together was claimed that the highest and best use of the property was a quarry, not agricultural, residential, and recreational land the way had been used, currently. They found that it was not financially feasible nor maximally productive, the court found, due to competition, high transportation costs. They believe the IRS's expert to be much better. They found the taxpayer's expert took, quote unquote, some liberties in reaching his conclusion. The court noted the market for the aggregate from the quarry would be limited to a 30-mile rail radius of the property. And many suggested, they said Mr. Mesmer, who was the IRS's expert, said that, and that many potential customers were further than 20 miles from the property. Also found taxpayers' projections were overstated, and net present value of his tax flow decreased nearly zero once you fix the problems, thus being there. So again, the court went back. Highest and best use was what we were using it for now, what it's currently being used for. Uh, you know, so rejected the experts because hypothetical quarry was not realistic. They were speculative and poorly supported, was how the court ruled in this case. Penalties. Okay. They said first the court ruled that the penalties were properly approved by the supervisors, right? They had complied with it. Mr. Phillips, who had been the immediate supervisor of the agent, right, had approved the penalties by digital signature on April 4th and had signed the letters 1808, which were sent to taxpayers on or after April 19th. And so they're saying, yes, those penalties had been approved by the supervisor and in interpretation of the tax court in a way that was in line with 6751B, which is a provision that requires supervisory approval. They found they were liable for 40% gross valuation misstatement penalty under 6662H because the claim value of the easements was well in excess of 200% of the correct value. And because the misstatement was gross, it went over the 200% number, there was no ability to use reasonable cause effect. Even if the taxpayer had reasonably relied upon the expert, that does you no good here. There are some penalties. This is one where, you can't just say, hey, I'm not an expert. I don't know how to value this stuff. And so, I relied on an expert. That helps you in some cases, but it doesn't help in this one, right? They also found that they were liable for the accuracy related penalties. For any portion of underpayment not due to the valuation misstatement, right? Although they recognized that reliance on professional advice could provide a reasonable cause, they found the taxpayer was not eligible for this exception. They found that Mr. Branch was sophisticated with regard to real estate. He was not I don't know just what I'm doing. I'm just a poor, uneducated, country bumpkin. I don't know. It said, no. You've been involved deeply in real estate for quite a while. You know real estate. You knew you could not have reasonably thought that valuation was right, or that these things were there, or what you were doing was going to work. So ultimately, right, we end up with the court ruling in favor of the IRS on all issues. Yeah, conservation easements have gotten a lot of attention from the IRS, especially the marketed ones. And we know that we know that recently we've had added to the law, Insecure 2.0, a provision that would kill this almost certainly. This would be way more than 3 times basis. But even in those situations, you still have this problem. And there are some things that do escape the Secure 2.0 3-time basis rule. So same issue there. Okay, it is that time of year. Revenue Procedure 2025-16. We have the new limits on the luxury auto, what we always refer to as luxury auto depreciation, even though these autos aren't terribly luxurious that hit this level at this point. And also the lease inclusion tables. This was published on February the 12th, 2025. Now, these are the depreciation limits for this year, right? What's going on? It applies to these tables 1 and 2 applies to automobiles, which includes trucks and vans, placed in service in 2025. Again, trucks and vans below the gross vehicle weight limitation, right? Now, if a vehicle, the first table deals with if you have a vehicle to which the first year additional depreciation, I'll get that out right, deduction applies, and you decide to take that, you don't opt out. In that case, with a first year depreciation bonus allowed, the maximum you can claim in the first year is $20,200. The second year is $19,600. The third year is $11,008, and each succeeding year is $7,060. Now, table 2, if you opt out a bonus, then your maximum in the first year is $12,002. Your maximum in year 2 is $19,006. Maximum in year 3 is $11,008, and for each succeeding year, $7,060. The information also in this ruling, you will find the information regarding the lease inclusion value for vehicles that are placed in service this year. Okay, so these are the long tables from the regs that go on and give you a different value for the fair market value of the vehicle at the time it's provided. At the time you buy it, you enter into it. So, for instance, if you take a look at the table, which we do have in the printed documents we have, and it's in the actual notice or an actual, IRS ruling here, you're going to find that, an example pulled there. If you have a car between $80,000 and $85,000, it would be $295 in the second year of tax is what you have to add to income if you're leasing the car. The item of the lease inclusion value is to make up for the fact that the depreciation limits don't apply to a leased car. So this is the add back. And again, it depends on the value. Again, if the value of the car is less than $62,000, there is no add back. And the table goes all the way up to $240,000. Actually, and once you're above $240,000, there is a fixed number there. Also, this comes in. We also have the inflation adjustment is 22.428%. It's applied to the 2018 limitations to determine the depreciation limits for this year, right? As noted, there are a few cases where the first year depreciation does not apply. If it's not used more than 50% for business purposes, right? Remember, we have those limitations. And this applies generally to any vehicles placed in service during 2025 or that have a lease term beginning in 2025. That's where we find these rules. Okay, now back to terminations of S corporations. This time, we did an ESBT once. We're going to do a QSST. And I'm doing these primarily because how many of these keep coming up. It is amazing how many estates, how many times people die. And what we're seeing in the fact pattern works like this. Taxpayer dies owning S corporation stock. That stock goes into trust, or it may already be in trust, if that revocable living trust, that then converts. But in any event, it goes into a trust. The trust that will exist after the death of the decedent is structured to be a QSST trust or an ESBT. But both of those require an election to be made. Once you've gotten past the point where we're past like the 2-year period that, testamentary trusts are allowed to hold the stock regardless, or hold the stock, S Corp stock regardless, without terminating the election. And what's clearly happening is people are, the death occurs, the stock goes to the trust, and nobody involved seems to understand, recall, remember that elections should be made. My suspicion has been for quite a while, we're seeing this because people tend to hire attorneys for estate planning. It's a natural issue until you think about the likely consequence. They tend to want somebody experienced, right? We're talking about big value numbers. We're talking about things, so I want to make sure it's done right. Okay, which is all well and good. Dad and mom want to make sure this is done right. So they tend to hire an attorney that's actually older than them, right? An experienced person, who does this. So the experienced person sets it up. The problem is if the attorney is older than mom and dad, or even the same age as mom and dad, there's a really good chance by the time mom and dad die, that attorney will either have died or that attorney will simply not be in practice anymore. And so the estate will be handled by a third party, a new attorney and very possibly new tax advisors, right? That's where this comes into play because all too often a careful study of the original agreement is not made because this is not the document that legal counsel is used to working with because probably it wasn't restated, right? They got drafted only when mom and dad died. And the other people working on the tax side, compliance side, they're kind of ignoring the problem. So by the way, key warning for you guys, whenever you have a death, remember, a death of an individual, they have S corporation shares, or if you're doing an S corporation and one of the shareholders dies and those shares are going to a trust, you better start getting on the record why that trust can hold the shares or get it out of that trust within the 2-year period that you have for a trust formed at the death of the decedent. Because if you don't, you're going to have a C Corp. So with that, let's talk about Private Letter Ruling 2025-07-006. Came out the Valentine's Day ruling, inadvertent termination relief. So yeah, we're going to go talk about this. Okay, here's basically the facts of this case. So, and we're going to use the letters the IRS used in the letter ruling. Obviously X is standing in for the real name of the company. But Corporation X had previously elected to be an S corporation. Now, a married couple, A and B, established a revocable living trust, right? It was trust one. This is normal. I practice in Arizona, and this is absolutely the normal estate planning option. Yes, that is true. There are some people live in states where, the traditional option is still to use the concept of going through a probate will going through probate. And that's fine. I always tell people I'm indifferent on the issue because from a tax standpoint, estate tax or income tax, we get the same result either way. The question of which method makes the most sense involves legal issues that often involve how that state's, probate system works and the other rules. But it's not my problem, right? It's not my issue. So in any event, we have this revocable living trust. As is often true when one spouse, the first spouse dies, so B dies. Okay, so now we have this joint trust with A. A now has this trust. This trust is going to divide into Trust 2, which is a revocable living trust owned by A, and Trust 3. Trust 3, they don't say for sure, but Trust 3 sounds a lot like, it's a credit shelter trust, right? It was to get the assets out of the estate of the surviving spouse and get it into, basically let it go on to the kids. So it would be something along that route or a modified variant of it. So we have this trust. It's intended to be a QSST, intended to be held by spouse, by spouse A. It could have been, as I said, it could be for that reason. It could simply be what's going to be a trust. We're going to use, a Q-tip style trust structure for just getting portability elections in place. But we have this second trust. And remember, what a QSST trust does really well is controls where the stock goes after, the beneficiary, the QSST beneficiary dies, right? That's really what we get with a QSST trust as opposed to just leaving it to the surviving spouse. So they did that. It was clearly drafted to be a QSST. However, the election was not made. That results in the S corporation's termination. It becomes a C corp. This was not noticed at the time. Obviously, it wasn't noticed because nobody realized that an election should be made, and everybody just ignored it. Whether they were unaware that trusts couldn't hold S shares, and I have run into some estate planning attorneys that are very, very, unaware of these S issues entirely. They don't deal with many in many cases, and that creates a problem. Because you see these in smaller companies. Don't see, yes, there are S corporations with bigger entities, but a lot of the really big estates don't have really S's, or they're minor, irrelevant. They're not getting in the midst of all these trusts. So in any event, we have this trust problem, right? Did not make the election. And by the way, we'll also say we know that they missed the problem for at least 3 years because under the automatic late election revenue procedure for S corporation, which includes QSST elections, you can make them up to 3 years late. So for whatever reason, either that or they failed to file a return on time, but nothing here says that. They blew it. Most likely went more than 3 years. As I tell people whenever this comes up, because somebody's going to say, the IRS never questions this. Why would you go get a rule and get it fixed? The IRS had not questioned at this point. Why would you go get a rule and get it fixed? It is almost always due to due diligence teams who are sent in when there is a proposed acquisition of the company, normally by a public company, and they're looking, and quite often they are looking to acquire the stock. There are reasons why, because they can offer, kind of a tax-free option easier to the person that's selling the shares. They get the big public company stock, and and they don't have to pay current taxes. There are various reasons why they will do it. I've seen it done as a stock deal. But the problem is, even if it's an asset deal, they don't want even the outside chance of it being said that they should have known that there were these huge unpaid C corporation taxes. And, and they end up with all the assets of the corporation. So, hey, we want the stuff from you. They would prefer not to have that happen. So what they're saying is, because of that QSST election that was not made, we need to fix it now. Now, I should say, in this case, it may also have been due to the death of B, right? Or due to death of A, when a new, let's say we got a new estate planning attorney now, and we suddenly looked and said, where is the election for QSST? It was kind of a what election? It's like, oh boy. Okay, we need to fix this, right? Now, as noted, though, because they didn't realize there was a problem, all the information, they actually treated it as if it was a QSST, which was really amazing. So spouse A, the survivor, paid tax on the amount of the shares they owned, and which were in their revocable trust, and they paid tax on the flow-through income in the QSST and received the distributions, etc. Everything seemed to be fine. They just never made the election, which is kind of a problem. Well, so the IRS was asked, can you please say that this termination was inadvertent? Because they're allowed to do that. Under the law, right, the IRS can give inadvertent termination relief, right? They're allowed to, make that particular, finding. Under 1362F, they can grant relief. And in this case, that is what they did, right? The termination was due to failure to make a timely election, determined that was inadvertent. And so under 1362F, we're just going to continue to treat it as an S corporation as long as they meet the conditions of the ruling. Now, the ruling's conditions, the trustee had to file a QSST election in 120 days of the letter's date. Now, I found that a little interesting. I'm thinking, wait, QSST elections are filed by the beneficiary. That's what got me wondering if the beneficiary, now was deceased. And that kind of did it. But in any event, the trust files it. I don't know. It may also just be an awkward way of wording that the beneficiary makes the election, the trustee will forward it to them because the trustee asked for this ruling, or whoever. We don't know where it goes. A copy of this letter that they issued, the one they gave the S corp, that's not as all the redactions, without redactions, that's attached to the elections, right? And, it made no other statements on the tax consequences. They're not saying they're eligible to be an S corporation, that's another problem, or trustee was eligible to be a QSST, right? They're saying, look, we're not ruling on any of that. We're just ruling on the fact that that election date was missed. And also remember, the ruling is only directed at this taxpayer, cannot be used by another. And the reason that's important is you can't say, well, my client did exactly this. This is exactly the problem my client has. So we're just going ahead and say, we don't need to get a ruling. If the IRS comes in, we'll just show them this one. This case, that really doesn't work. The general prohibition on relying on a letter ruling is what the last bullet point refers to, and the end of the letter refers to. But in this case, it's doubly true. You cannot, because 1362F requires that the IRS have granted the relief. And they're not likely to grant it if you knew you had a problem and you just ignored it, and the first person to find it and raise the issue is the IRS. So yeah, it is interesting. Okay, next up, we're going to talk about the government's filings in their motions filed with regard to Texas Top Cop Shop, community associations, and Smith. And remember, as noted, this is, the brand new filings that we have. This is with the new administration, right? And again, there was a lot of discussion that the new administration might change its approach. It's fairly clear from what we've seen in the filings so far that the approach is not being changed. If you thought that the incoming administration would decide to, slow walk this stuff, would announce broad-based big relief overall. Yeah, we don't appear to be getting that. So just let you know. Let's take a look at this. Where we're at right now, I just want to compare it. All of the briefs filed in all three cases show that say the CTA is a valid exercise of Congress's power under the Commerce Clause and the necessary and proper clause. Right? There is a strong implication with the Supreme Court's ruling in Texas Top Cop Shop. There's a strong implication when the Supreme Court took away the preliminary injunction against enforcement, that the Supreme Court, essentially found that the court was in error in deciding this. It becomes funny because at the end of this week, the taxpayer, or not taxpayer, because it's released in a tax case, the plaintiff in Smith, the one who said that she was being harmed by having to do CTA work, they still repeat this line. They have to. They've got to convince that court that its original injunction is fine. Fine. Yeah, no, it's like, I don't think it's going to be fine. If it really was as fine as their statement saying, the Supreme Court would not have, not have wiped out the first injunction. It just, we don't know for sure. They didn't tell us why they did it, but it seems implausible that if they really thought the Congress didn't have this power at all, and that there were horrible constitutional violations taking place, that they would have said, yeah, keep sending this stuff in. Or maybe, and I doubt they were sitting there saying, and yeah, we're going to rely on this other case. It's virtually identical, and that injunction there is good enough. It's like, that seems unlikely. I suspect the Fifth Circuit's going to reverse on this. I think they will at least get the clue, even if the judge in the Smith case maybe doesn't pick it up. It certainly seems like it's risky to go forward, but we're there. It says the CTA regulates an ongoing activity in the act of incorporation, that, the theoretical LLC that never engages in commerce is just that. None of these cases have shown a single plaintiff in the case is that LLC that doesn't engage in commerce, or the corporation doesn't engage in commerce, right? That theoretical is not there because that theoretical, yes, they do exist, but they're mainly ones that are what you might call the ones that like law firms bank and have set up on the side so that they have an already formed LLC if a client comes in, right? We just take that off. We don't have to go through formation. We can just transfer this one to them. They finally fund it up and we get going. So yeah, they're saying they're used heavily in this. So that's going to be the background, that, the normal use, the reason you do an LLC or a corporation in virtually all cases is because it's going to engage in commerce, okay? The reporting requirements are minimal and do not violate the Fourth or First Amendment, and it's crucial for combating financial crime and protecting national security. Now, remember, we did have in the Smith case, the FinCEN did commit to making some changes and adding some exclusions. But what I'll note about that is, they also made it very clear they were going to go after, and really try to get more aggressive on enforcement against, quote, the bad guys. So we'll have to see what's there. But generally, I also would not have been surprised regardless. Even the prior administration may very well have agreed to make that change. So we'll see. And by the way, that's never mentioned in the others. The other briefs never mentioned that, yeah, we're going to fix it in 30 days routine. Okay. Now, Texas Cop Shop, I get that right. This one spent a lot more time on the fact that the court considered hypothetical scenarios, not actual scenarios, to invalidate the law. That is the show me an actual LLC that is harmed by this, that is not engaged in interstate commerce. None of the plaintiffs before you, nor did and they had a national organization. They didn't produce a member of their organization that could meet that criteria, the hypothetical criteria, right? It should have been. And, and also they make much more hay here on the district court's nationwide preliminary injunction being improper. Again, remember, that's what Justice Gorsuch thought the Supreme Court should have taken and held a separate hearing on, right? And acted because he believes that should be stopped. Single district courts shouldn't be able to issue nationwide injunctions invalidating a law. Community associations, this more directly addresses the CTA's link to the taxing power in the Constitution, because these are exempt, quasi-exempt organizations, right? They're kind of, but not really, right? They're homo associations, HOAs, right? Provides more detailed examples of how the lack of beneficial ownership information has been used to facilitate illicit activities. They weigh a lot more heavily in this one on that issue. There's more discussion of the specific nature of the plaintiffs. Remember, one of the issues in Community Association's case was that they should have been granted the exemption for being a tax-exempt entity. Now, they may very well see at this point, having read what was said in Smith, that, they're getting ready to lobby the, basically FinCEN saying, HOAs really should be excluded from this, right? At least if they meet certain criteria. HOAs should be excluded. We don't think that they're owning other assets or that sort of thing if they're truly just HOAs. So we might see them decide to start focusing over there in that FinCEN is going to make changes theory. But it's still brought up here. They provide a more detailed explanation of why the plaintiffs do not have reasonable expectation of privacy over the information requested by the CTA. They're going to say, in essence, they didn't have a reasonable expectation. They never had to provide this to the government, because there's lots of reasons why these organizations are providing virtually all that information to the governments, different governments. And it analyzed the compelled speech doctrine in more depth. Was it forcing them to make speech, which is not good, right? Does that. Now, one other development that took place this week on the CTA. The House passed a bill which simply takes from the old continuing resolution, just pushing back the due date for the initial filings from January 1st of 25 to January 1st, 26 for entities that were in existence on January 1st of 24 by that date. Now, it passed the House unanimously for everybody that was there. There are 480 votes in favor of it, right? So it passed unanimously, right? Very, very much did whatever. I think it was enough for whatever. I have to get my numbers right. That's too high. Anyway, but it did pass unanimously. And it has now been sent to the Senate, but it's been referred to committee in the Senate. The problem is we don't know when and if the Senate will actually pick this bill up, because they don't have to. The fact it passed overwhelmingly in the House is good news. It appears nobody's against it. But will the Senate find time to pick it up? That's a different question. But keep your eye on that as well. But don't forget, even if that passes, that bill is very simple. This is not an oversight or the person that drafted the bill, if this is an oversight, really, really needs to go back to law school, I'd hate to say. I'm sure it's staff attorneys. It's like, because, clearly, it's very clear from the language they put in there that it only affects companies that were in existence on January 1st, 2024. And we know the law impacts companies formed in 24-25, many of whom have already hit a deadline date with nothing blocking enforcement on the date their deadline came up to do the filings. So that means any brand new entity formed in 25 would still have to file. There are some that are in limbo because they signed up, they got created late in 24 or being created currently in 25. And so they're still covered by that, injunction under Smith against enforcement. They would have to file probably by the 30-day deadline that FinCEN is talking about doing after the date the injunction is lifted. And the others would have to keep filing if that comes true. So if that bill passes, it's not an absolute. We don't need to worry about this anymore. First thing is, it's still come due the first of next year, right? It's there. And secondly, the idea of that is to let the Supreme Court rule on the validity of this, which, as I said, they have seemed to signal they believe it is valid, and then just get it all done next year. So that's where we stand. Final development this week is the House Ways and Means Committee. They considered a number of tax bills. Now, this is specific to the Ways and Means Committee. and what they did. But the good news we're going to say about all of these bills is that they all passed unanimously out of the committee, right? All members, both sides of the aisle, voted for all four of these bills. Now, they all make some very basic administrative changes. So they're not, huge things. Later in the week, the House did pass a budget resolution. Now, this gets down the whole reconciliation program path, and the Senate would have to pass an identical one. The Senate's currently working on a very different budget resolution. So we're not there, but it does mean the House is going to get started, assuming the Senate will go along with that resolution. And the House Ways and Means Committee is going to start drafting a bill. The House Ways and Means Committee, I'm just going to give you roughly on that. It's not written up in the materials, but they were given instructions to write where they could spend they could basically have net tax cuts over the 10-year budget window of $4.5 trillion. However, that's conditional. The other committees are supposed to find $2 trillion in savings. If those other committees fail to find $2 trillion in savings, then the $4.5 trillion must be reduced dollar for dollar. And it's unclear whether that was, and I believe I have a couple of sources said that really only counts down to $500 billion potential decrease. Others have suggested it goes all the way through the $2 trillion. I will have to see. That particular reduction clause was the only way it got out of committee and got out to the floor. That was the only way it got out due to the budget hawks. So budget hawks definitely have control here. It's also not totally clear how they're going to score this. That'll still be in play. The Senate appears to be the one, though, that truly wants the scoring to be basically current policy, not current law. This appears to be a current law scoring. And that is difficult because the $4.9 trillion number, it appears to be enough to extend the TCJA, but not enough to then also excluding the categories of income that the president had promised in the campaign trail would not be subject to income tax. That would include tips, overtime, and Social Security benefits. Now, there still is a question about Social Security benefits and where they can go into a reconciliation bill anyway, changing the taxation of them. But the other part of that is the overtime is the hugely costly one by most people scoring. Obviously, they'll have to make choices. My guess is with that scoring, overtime is not going to be part of this, or it has to be very, very restricted and a very limited time provision. Again, we're still guessing how they're going to score, so we have to kind of work with that. But it does seem like we're going to have, that could make that tough. If I had to bet, it's been ever since we started this, I bet the tips make it. I think the other two, Social Security, there's going to be the whole question of whether the Senate parliamentarian will say it can be part of the bill to have it excluded from tax. And then the overtime one is just so expensive and would be so easy to game that I just don't see it. I think that'll be the one to be dumped. So in any event. But what are these admin bills? And let's get back to what we have, which have actually cleared. We know what they are. They've cleared. The first one is H.R. 977, which is the National Taxpayer Advocate Enhancement Act of 2025. The main thing this act does is allow the taxpayer advocate to, in essence, hire and appoint her own counsel. She doesn't have to borrow from request any legal assistance from the chief counsel's office, where she may be at odds with them on various things. She essentially has it, right? So essentially it does that. It also modifies some language regarding employees of the Office of the Taxpayer Advocate, right, to make this work, right? It's basically that's there. There was a minor amendment that the chair made to fix a drafting error. It changed the word amendment to amendments because, apparently it had a reference to the original Act Taxpayer Advocate Bill, and its amendment, and it's been amended more than once, so they're amendments. That's what we're doing. The second bill is H.R. 1152, the Electronic Filing and Payment Fairness Act, right? Now, what this would do, it would amend Section 7502C of the Internal Revenue Code to include electronic filing and payment under the common law mailbox rule. Sure, what does that mean? The mailbox rule would mean that it would be just like the old common law mailbox rule, which when you put the envelope in the post, in the mails, for those things covered by the mailbox rule, which interestingly enough, tax returns aren't, according to the regs. But when you put it in the mailbox, it's deemed to be received by the other party on that date. So in this case, it would clean up. While the regulations provide for this, the code itself doesn't. So this would add to 7502 a provision that would essentially say, when the document or payment is sent electronically as the official date, that'll be the date it's deemed received by the IRS, regardless if something internally fouls that up. Right? So that means that payments would be as of the date you basically, tell the system to send them to the IRS, and also your electronic filing. The date it is sent to the IRS would be the official date, regardless of if there's some hiccup in the system. As long as you could show it had been filed by that date, you would have it. The IRS would issue regulations to carry out the purposes paragraph, probably telling you the type of evidence you're required to keep. If, in fact, this passes, it's going to be really important for you, those of you who prepare returns and file them electronically, or help clients with electronic payments, to communicate what needs to be kept as a record to prove the date of submission, the date it was sent electronically. It would apply beginning next year in 2026. So the IRS has some time to get regulations, but effective, anything sent January 1st of 26 or later would be covered by this bill, assuming that this bill passes the Congress. Please remember, currently it hasn't yet passed the House. So while the unanimous vote in Ways and Means looks really good, and it really looks really good, please remember that last year, a bill that went out with almost unanimous support of the House died on the Senate floor. So none of these are absolute slam dunks. The next bill, we have the Recovery of Stolen Checks Act. This has been reported to be a major problem in the Northeast. I've heard a lot of CPAs in the Northeast who've had clients that have had checks intercepted in the mails, and then basically, check washed, and various things happen, etc. So if a refund check goes awry, right, you do not have to, because now let's think, if somebody's stolen the check sent to you before, right? So you went through, IRS looked, clearly the check's been manipulated. Okay, so we're going to send you a refund. Under current law, they send it the way you requested on the return, and because you requested it to come by mail, they're going to do it again, which you might have less confidence in. A lot less confidence. Now, I know that for me, it's been a client that insists they don't want to tell the IRS their bank account number. But they may be different if they had a large refund check that they're not getting their hands on, and it's very obvious that, people steal checks in the mail. It does happen. So they will be able to, a situation where a refund check was lost or stolen, they'll be able to now tell the IRS, here's my bank account number. Please direct deposit the replacement payment so that we don't put it back out in front of a party who may not have been caught yet and who might just intercept the next one coming by. So that'll be there. Now, if they pass this, the date the president signs it would be the date that the IRS would be required to start offering this option. So the IRS probably is going to be kind of focusing on developing some standards there. We're going to see what happens there. Then finally, there is H.R. 998, which is probably going to be the biggest thing you're going to see. And this is the Internal Revenue Service Math and Taxpayer Help Act. Now, I did note this week that Democratic Senator Warren has introduced a bill in the Senate that seems to do much the same thing. I don't know if the idea is here to get, companion bills going and do it. If that's the plan, it's a little bit interesting. She would be the one to start it, if it is, or if she just would like credit for this, whatever's going on. But, it's going on anyway. It is a bipartisan thing. So we'll see what's happening. This is going to require improved information when the IRS gives a notice of a math or clerical error. So things it would add to the code for requirements. First, it would require such notices to be sent to the taxpayer's last known address, right? They need to describe the error in comprehensive plain language. But then what I find hilarious is the next bullet. It must show the type of error, the section of the code it relates to. Hate to tell you this, most non-tax, non-attorneys, non-tax people, the minute in fact, a lot of tax people, the minute you put a code section there, they will automatically see the notice as confusing. So I find it interesting that we're going to do plain language. We're going to include the code section. I know why. I want to see the code section. I really need to see that to try to figure out with the client what's going on. But I can also see how it gets in the way of plain language. And a description of the nature of the error, right? Has to say specific line of the return where the error occurred. That helps the taxpayer figure out, can help us figure it out too. That's what's going on. Must include an itemized computation of any adjustments made to the return, right? Include the telephone number of, for the automated phone transcript service, and display the date by which the taxpayer may request to abate any assessment in bold 14-point font size, immediately next to the taxpayer's address on page 1. It also says the notice should not list multiple potential errors. However, if multiple specific errors apply, they should be listed, which is another one of those, okay, right? So, the problem is to do this, right? If there is an abatement that's determined to take place, then, they send a notice to the taxpayer description of the abatement. It applies notice is sent out of the date, which is 12 months after the date of enactment. So they'll have a year to put this in. And again, they have to provide procedures for taxpayers to request abatement in writing, electronically, by telephone, or in person within 180 days. There have to be multiple ways to do it. They're also going to do a pilot program in 18 months of the enactment to send a trial number of notices of mathematical clerical error by certified mail with e-signature confirmation of reply to use that. And they have to report to Congress on the results of the program, right? So a lot of what you see here on the additional provisions is going to go up here. Again, these are only now past Ways and Means. They are on the very, very first step toward enactment, but you might want to keep your eyes to see if these come to a floor vote and if they start moving in the Senate. Okay, we may see. What I'm seeing right now is there obviously has been talk. Again, the parties right now are warring for TV cameras. They always do that. But there are talks going on in the background for getting these administrative cleanup issues taken care of and doing so in a way that everybody agrees to. So we have, as I said, the bipartisan proposal that the Senate put out, which would clean up a lot of issues and really make some nice changes some places. The only thing which I think most preparers are going to be a little bit concerned about is the increase in preparer penalties to pay for it. But, we'll cross that bridge when we get to it. Then we see these proposals as well, which again, unanimous basically acceptance of these provisions. Okay. This has been the current federal tax developments for the week of February the 17th, 2025. Current federal tax developments are brought to you by your state societies of CPAs. My email address, edzollers at currentfederaltaxdevelopments.com. You have a question, you can email me there. If I have time, I'll try to get to them. I also do spend some time skimming over, items or entries made on the Connect site for various state CPA societies, Arizona, New Jersey, Illinois, Minnesota, Washington. I look at those things. And if I see something there, I may respond to it if I think it could be of help. You may take a look there and see how that goes. Otherwise, we are another week going. As I noted, we are now, and I know it was true, this week I was out giving my last, this current CPE season update to a CPA firm, an annual tax update. I was traveling, so I was out giving it in the San Francisco Bay Area. is where I was roughly. Yeah, we'll give it that way, right? We'll say there. Don't need to disclose the detail of exactly who. So, if you're if you were there, you were there. We were there and having that going on. So I've done that. So it was like almost exactly the wrong time, because as soon as I got into the Bay Area, the clients all started getting their brokerage things. So I just had a whole bunch of things coming in and managing electronic transfers of these stuff and doing it remotely. It was great fun. But I'm back in town now for good for the rest of the week. And you all probably saw that stuff get released too this past week. So hopefully you're ready to put your head down and plow your way through. First deadline coming due, March 15th. I know most of those will probably end up going on extension for most of you, right? Because you're just, you're trying to get the 1040s together. And if the pass-throughs are ready, that's fine. But, you'll probably look at a lot of them go on extension, because a lot of them, they need more work than there's going to be time to do, especially if they haven't yet come in. So in any event, we will see you next week here on Current Federal Tax Developments.